Hi, I'm Peter Rose, founder of Longwood Currency Trading. Retail Forex trading danger increasing is the topic I want to cover today. I'm inside instead of outside. I did this video already. I thought I'd walk around outside because it's like 80 degrees. This is early July of 2026. So I thought I would get out. A hot day. Sue and I went kayaking yesterday. It was great. The weather's great. I thought I'd go outside and record my video because that would be great. The whole thing is washed out. My ISO just won't handle the sunlight. Okay, so let's talk in here. Retail Forex trading danger increasing. That's not a clickbait title, but it indicates that something's changing in the Forex market. It's changed so slowly that I didn't recognize it until actually today and confirmed it. Let me tell you the story of what happened, and then I'll tell you what the danger is and where my concern rests for you as a retail trader. So we had some major economic indicator release numbers that were going to come out today. I mean, major in relationship to the political and economic situations, as well as the international situations that are involved regarding the dollar, because I trade a dollar-based pair. And the expectation there was all these indicators are that the U.S. economy is gaining strength and it's robust. Unemployment numbers are down, jobs listings are up, personal consumption index is up. Just all these are saying in this environment where we come out of a really high interest rate situation, and the Fed just came out and dropped rates a little bit, and they said this is going to continue as things, all that economic horse shit. Well, over the past month or so, the economy has becoming more robust, and so the inflation rates are down in a little bit, and things are, we're doing okay, but they were stabilizing. They weren't really going anywhere. And so instead of this very active part on the Fed to reduce interest rates to counteract that, they've just kind of been non-committal in what they're doing. And I think what we're doing was waiting for today's numbers to come out and then the next NFP to come out. Because what happened today was all the numbers came out strengthening the U.S. dollar in a major sense. I suspected that. Jesus, if I just stayed in my rules, I'd be okay. I suspected that, and I set some limit orders that were far enough out so that if the dollar strengthened substantially, the order would get kicked. I'd take 10 pips, be happy, set another order just beyond that, so that if the movement was going to be sustained, as I suspected that it would be, that would trigger, and then that was for a long haul run. That could have probably been a multi-day hold. So in trading, well, let's look at what someone's more familiar with: euro dollar, pound dollar. The strengthening of the dollar would be a decrease in those two charts because the dollar is the denominator there. So if the dollar gets stronger, then it means that the pound or the euro fall. So I'm looking at the DXY, and I've got the pound dollar chart up, and the numbers come out. And instead of the dollar strengthening, it went just enormously negative. I mean, enormously. And I looked at the Dixie, and that just dropped. Like it came to a cliff and went, it fell over the edge. And I go, isn't that interesting? I didn't get caught in that because my limits were, I was obviously short pound dollar, and it didn't go short. It just went immediately like freaking crazy. Isn't that interesting? So I sat back and had a sip of coffee. I don't have much left, so I'm going to make this short. And I said, I just learned within the last 7 or so months that the total dollar volume of the Forex market has gone from 6.7 trillion, which is what I've been saying in all my videos for the last few years, to 10 trillion. And so I did my analysis of well, what component of the retail market has the retail market in this volume. When I started studying the general overall Forex markets in 2007 as a $3.4 trillion a day market, and it grew and grew to or maybe it was 4.3, I forget what it was, but then in the 2000s and whatever it was, the 6.7 trillion, and the retail market had about 15% of that as we were going through, maybe a little bit less than that as we got to 6.7 trillion. So I looked at that again, and the retail market is only 5% of this $10 trillion a day market. So the institutional traders are now 95% of that market. Now, you would say, well, okay, well then that gives the institutions far more a dollar volume, so we could follow. It's far more liquidity then for the three major pairs, primary major pairs, which is the euro dollar, the dollar yen, and the pound dollar, comprise 47% of the overall volume. And so everything should be jump ball. So I get to today, and it does exactly the opposite. There's this enormous spike like you'd see on an NFP. Well, this isn't an NFP. These were just economic numbers. They weren't the ball buster NFP number that comes out. These are numbers that are more long-term. So why would you get a jack like that in the price? And I sat back and I said, I don't necessarily pay any attention to the fundamentals or, God forbid, to any of the technical stuff that's being taught out there. If you guys are being taught Fibonacci's and Bollinger Bands and all that shit, drop that, send me an email. Let's talk about this and get you off of that stuff. And you shouldn't be studying the fundamentals either, because you don't have a floor full of PhDs in economics and linguistics and social sciences and all that stuff to figure out from a fundamental standpoint what these two pair countries are going to do, battling back and forth against each other on interest rate policy. And you don't have that ability. So if you're trying to play that game, you're going to read the news, which 90% of the traders do. So you're losing money. And whatever. So 15% of the market were losing money before. So now it's 5% of the market and you're losing money, but you're losing more money than you should. But I'm interested in macroeconomics, so I follow this stuff, but I don't trade by it necessarily unless we're around a long period of growth, which you would do anyway. If you saw increasing interest rates, then you'd bet on the country that had the higher interest rates, and you'd buy that, because that's what drives the order flow that the institutional traders are doing. The institutional traders are buying and selling currency pairs based on the needs, not their needs, but on the needs of the client. And so what we've heard in the past is, oh, the institutional traders are stop hunting us. No, they're not stop. They weren't stop hunting you. You were just in the way. They were putting their orders out there, and you just happened to have your orders in the wrong spots, and they scooped them up. I thought this anomaly today is wrong. This movement wasn't an anomaly, but it was an anomaly for what it should have been and what it should have done on a long-term basis. It shouldn't have done what it did. Why did it do that? Well, the retail market obviously doesn't have the ability to run that up. What must have happened is that the retail traders were on the wrong side of these numbers, and they started scrambling to get out. And the institutional trade, even though it's only 5% of a $10 trillion a day market, that's a lot more money than 15% of a $3 trillion a day market, right? So there's an enormous number of limit orders out there for a lot of money. And the institutional traders have been, in this case, buying the dollar for that strength and all the rest of the stuff and betting on this stuff. So the rise, these numbers didn't come out as a surprise. They should have acted as a continuation for the institutional buying of the dollar. But that isn't what they did. They saw all these blocks of orders with all these, not stupid, but ignorant. Stupidity is just a physical condition. Ignorance is you just don't know something. You're looking at all these ignorant retail traders, and they've got all this volatility, or all this, not volatility, but all these orders out there that are in the opposite direction of where the price should be going. And I've got a lot of stuff. Why not take advantage of all these retail trading orders? It's a lot of money, and fade them to it'll cause the dollar to turn around and go against. But we're getting rid of the dollar at this higher level, and now the dollar will be down here, and we'll flush all these guys out, and then we could start buying the dollar again at a lower price, and it's a wonderful thing for the institutional trader. And that's exactly what happened, because the thing went skyrocketing up, and then it continued to go higher, and then it came way back down. And I thought, okay, we're in the retracement here. Bad decision, because I'm trading fundamental here. This should continue. I got on the wrong side of it. Yeah, so I'm 40 pips down. But that's okay, because next week it'll be different. And if it isn't, then, I'll be out a lot of money. But because I made the wrong decision. I traded during these economic releases. But the reason I traded during this economic release is it wasn't supposed to be such a big deal. I might have been able to make 3 or 4%, and that would have been fun. That was fine. That wouldn't have been any major movement. I mean, the ATR is like 70, 80 pips a day, or has been. So a 40 pip move, it's a half an ATR. Come on. So when you're looking at being a retail trader, you're the tail in this, not the dog. You're not wagging anything. And we just saw the institutions wag us as retail traders. The danger that's increasing is that the institutional traders are now becoming more aware that we as retail traders are a wonderful source of food and liquidity. And if you're not aware of that, or the reason why it's happening, you'll continue to listen to these fools out there that are trying to teach you technicals and fundamentals. Technicals are not going to work because they are not based on order flow. They're based on what happened in the past. And that has no indication of what's going to be happening now. I can't emphasize to you the danger that you as a retail trader are going to face by betting your opening on technical indicators. And I am cautioning you even more strongly to be aware of the fact that the dangers of studying fundamentals or saying, oh, I think. Listen, if I have a student that says, well, I thought, I shut him off right there. And you know what I say? I don't care what the fuck you thought. The fast track program teaches you not to think, but to react to price action in a risk management manner. And that doesn't require you to think about anything. It requires you to consider the delta between the rule that you have and what's currently happening with the price action that's going on, and then to make your probabilistic determination of what you should do. I've been teaching this stuff for a long time. I'm an educator. I've taught martial arts for 55 years. I've been involved in karate and self-defense for 57, 58 years now. I've got a degree in physics, almost a minor in math. So I'm familiar with education, both on the academic side and also on the personal side. And education is always dealing with fear, right? You're afraid of buying the wrong kind of house, and so you study house construction so you can determine if the roof is in good enough condition or whether it's going to need replacement. You got a $20,000 roof replacement. What are you going to do? Buy the house for asking? No, you're going to drop it $10,000 or $20,000. You point to the roof or whatever. So you need to understand the market is not changing. The flux between institution and retail is just simply becoming more intertwined. There can't be all institutional trader and no retail. There can't be all retail and no institution. That's the balance of nature. The Chinese talk about that in the yin yang. If we're going to be retail traders, we are the tail of the dog. If you'd like to learn how to be a good tail and let the dog wag you in the right direction, then you might want to send me an email so that we can get a discussion going to determine if the reason that you're not having the success that you need to have, what you need to do if you're not confident of what you've been taught, is to simply send me an email so that we can talk. I'm not going to try to sell you anything. I don't have time to work with everybody. So chances are you might be interested in taking the course, but I won't have time to fit you in. To take Fast Track, it's a 6-week course, and I'm teaching that course. There's a manual, but I'm teaching it, so it's my time. I don't want to. I'm retired. I'm not working 40 hours a week teaching currency trading to the masses. I'm looking specifically for that person that says, ultimately, I'd like to replace my job income, or at least come enough of it so that I could live. I don't have to work. If you're like most folks, you can't come up with $1,000 in a medical emergency. So what's that going to be like when you're 50 years old and you can't get a job because job discrimination is there or you haven't kept up with the technologies? That's what's happening right now. I'm talking to a lot of people that are very concerned about the longevity of their job, their kids' environments, and what they're going to do as they get up to the point where they're facing age discrimination. That age discrimination used to be 50. It's now dropped to 40. With all this technology change around, if you're 40 and in a mid-management level and you don't know how to manage AI to do all the work, you're gone. You're history. You're a hole in the carpet is what you are. I've been around a long time. Maybe I can throw some light to help you. If you'd like to talk about the Fast Track course, I'd be happy to discuss that with you, but I may not be able to fit you in. So that I've only been really talking about this course for about a year now, and it's kind of under the cover, and I don't have very many subscribers and views, so there aren't, and I only talk about it toward the end of the video because then the idiots that are up front and dropping out at the 1 minute mark don't even get to hear it. I'm only looking to work with you if you are seriously concerned about your economic viability 5 years or 10 years from now. The Fast Track course in 6 weeks can present you a roadmap that you'll carry forward for the rest of your life. So you're making an investment in the rest of your life, where if you're taking, somebody's $2,000 course or $500 course, that's good for tomorrow. But when everybody finally figures out the fibs don't work, or Bollinger Bands or London Open isn't working anymore, blah, blah, whatever the shit is that they're talking about, or they just wave their arms and say, oh, look, I got this engulfing candle pattern. Jesus, how many... Take a course. I took a course in engulfing candle patterns. I look at myself, why didn't you pick this engulfing candle pattern? Well, because bullshit. It's either an engulfing candle pattern or it's not. I've got 4 of them up here and you're telling me that you picked this one and not those, but you're not telling me why, because you don't know. That's the problem that you're going to be faced with. That's the problem I was faced with when I started learning Forex, because I took those courses and I read all the books. I've got shelves of books. I'm an educator, so I educate myself. Oh, that's a big mistake. You need a mentor to point you. If you send me an email and you just need pointing, I'm happy to point you. If you need somebody to organize your thought process around a longer term view, All these guys out there are trying to do is get you to buy a Lambo so they can say, oh, look, I trained this guy and he bought a Lambo. So 1 out of 500 might be able to do that. But he's still pointing at that guy, and that's who you believe. Man, that's not the attitude of the person that I would want to be watching my channel. And that's not you, right? You're serious about what's going on. You got to this point in my video here. And there are retail Forex trading dangers increasing because of the way of the new connectedness between the institutional traders and the retail traders. Does that change what I'm teaching in Fast Track? Absolutely not, because I never taught outside the boundaries of what good risk management and rule solution is. I was a software engineer for 33 years, for God's sakes. I know how to solve problems. And once I lost a lot of money, and if you go back in my videos, my whole sad story is there. In 15 minutes, I said, I'm going to throw all this stuff out, and I'm going to look at this like a software engineering problem. In 15 minutes, I developed what I call the life cycle of a currency position. I took my remaining $5,000 and just about doubled that in 4 months, which is about the time that it took me to lose $40,000 of my money based on what everybody else was telling me was good risk management. So all I can do is suggest that you send me an email. I'd be happy to chat with you. And if you send me an email, I'd be happy to also send my 7 steps to financial Forex trading success or something like that. Anyway, it's got 7 problems that when I was getting started in Forex trading, 7 issues that I ran into and how I looked at them and how I went about thinking about them in a different way so that they wouldn't be a problem. I'd be happy to send you that. It's a little 20-page PDF document that I send out for anybody that takes the time to email me. If you're nice enough to email me and chat, I'll give you that. And you can see whether I know what I'm doing or not. Video is too long. Thank you for hanging on there. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.